We will now move on to a panel discussion. Could the panelists come up onto the stage, and please welcome the panelists with a round of applause. I'm now going to give the microphone to Ferenc, who will be serving as the moderator for the panel discussion.
Hello, my name is Ferenc Sanderson. I'm executive advisor for Visual Alpha, and we've been working with FinCity Tokyo on our Emerging Manager project. This is very important for a number of reasons. Probably the biggest reason being what is happening and what will happen to the assets of global asset allocators in 2030, so in the next 5 years. I looked at some research recently, and it suggests that the amount of money will more than double from today, or last year, approximately 70 trillion to about 160 trillion. So there's a lot of money moving around. And according to my estimate, that means that there will probably be just shy of $1 trillion extra dollars worth of assets from big institutions potentially available to be invested in Japanese managers, which is a lot of money. Today we will try and answer 3 basic questions. Why, being one of the most important ones, how, and the third being what. And each of them apply obviously to asset allocators, but also to the managers, and hopefully this will be interesting for you. We're lucky today to have a number of diverse allocators in the panel, and I'll hopefully ask some questions and we'll all together learn a little bit more. I'd like to ask each of them to introduce themselves before we get stuck into the details. Please, Kirk.
Hello, my name is Kirk Sims. I run the Emerging Manager Program for the Teachers Retirement System of Texas. The Emerging Manager Program is a $6.2 billion US portfolio. My objective is to invest in private equity, real estate, infrastructure, and public markets. The definition of an emerging manager for us is Fund 1 through Fund 4, a fund size of $1 billion USD or less, and a firm size of $3 billion or less. Look forward to the conversation.
Hello, my name is Daniel Jim. I'm a senior advisor at the Chartwell Family Partners. Chartwell Family Partners is an alliance of 6 either indigenous or multi-generation families from Hong Kong. We also have an extended network of around 40 to 50 Hong Kong-based families. Most of these families have been investing in managers over, decades, and a lot of the times, they will be investing early into a manager.
Bonjour, Philippe.
Hello, bonjour. Yes, I'm Philippe Paquet. I'm the managing partner of New Alpha Asset Management. As you can see behind me on the background screen, so we are based in Paris, and we are an investment manager specialized in designing, structuring, managing emerging program for account for allocators. It's manage the emerging manager program of French institutional investors called EME, which has raised about $1.4 billion and successfully accelerated the development of about 35 managers. We are also managing some programs for the account of large North American allocators, both in hedge funds and in public equity space.
Great. So let's start off with motivation. And I guess, kick off with you, Kirk. What was the motivation for Texas to look at emerging managers, and how has that changed for you since you started and helped lead that program?
The initial motivation was to engage with managers at an early stage of their life cycle, to be able to find new talent and to build a relationship with that new talent. When we initially started, the focus was in private markets, primarily private equity. We looked to build those early relationships, grow the managers to the point that the pension plan could invest a larger sum of capital. Through the success of that relationship, we looked to build other asset classes. So we added real estate, and then we added public markets, both hedge funds and long only. And finally, we added infrastructure when I joined in 2019. For us, what we found is that the early relationships are really important as firms become successful and they grow. There are so many very, very large firms that even if you're writing a large check, maybe that doesn't get you on the advisory board. Maybe it's hard to contact the founder as they get larger and larger. But when you were there at the beginning, when your assets were extremely important to that organization, they never forget that. You always get the benefits of engaging early. They will always pick up the phone. You will be able to participate in the advisory board. Things of that nature are really important as you try to engage with these managers early.
Just a quick follow on. So how do you find these guys? So for example, do they come to you, or do you engage other people to help you find them? How does that initial engagement occur?
Yes, I think in some ways Texas Teachers is unique because we've been doing it for over 20 years now. We host one of the largest emerging manager conferences in the country, and that conference is virtual. As a matter of fact, it is coming up next month. So if you're interested in attending the conference, let me know, or engage with Fin City and they will be able to give you the contact information. But that conference is virtual. And what we've done is we've built a conference that allows managers all over the world to engage with us and other allocators, because it allows at least that initial conversation. So we get a lot of inflow because we're so well known. The other thing is I spend a lot of time on the road coming to events like this. I've been working with Fin City now for almost 4 years, and it's very important for TRS, the Teachers Retirement System, to build out the ecosystem of emerging managers, to give us more opportunities to find talent at an early stage. So it's us working with organizations like this, it's us hosting one of the largest conferences in the country that allows a significant amount of flow. And then we can talk about structures of the program later, but that's how we engage.
And Daniel, what about you? Obviously, you're not a multi-billion-dollar public pension plan. what was your motivation, first of all, and secondly, how do you source new talent?
I think, first of all, maybe we should define a little bit this term that recently have been probably overused a little bit, called family office. The Hong Kong families, I will say up until probably the last 5 years, thanks to our government of promoting this concept, have never been going around and tell people that we are a family office. Usually it's people tell us, oh, you are a family office. Okay, I'm a family office. Okay, why are they investing in managers? And that goes back to my point about definition of family office in Hong Kong or in Asia even. I think contrast to those that we see in US or maybe in Europe, you will find that most of the families, they are still actively involving in their family business, which is very different. If you talk to a multi-generation family office from Europe, they probably divested, a couple of generations ago, right? So they are still in a certain capital expansion mode, or at least that's their mindset. So a lot of the times when they're investing in other managers, the number one motive is actually to diversify their risk, because whatever principal business that they're in, it's a very focused area that you will be exposing to a certain type of risk, right? Nowadays, you don't need me to tell you, of course, geopolitics. It's a very big risk for a lot of us. And so a lot of the times, that's why there's always this motivation for us to look beyond Hong Kong, to be a little bit more global, to look for something that can add in a little bit of a spice and having a very, very low correlation with the risks that the family business is exposing itself to.
So hold on one second. You said to add spice. What do you mean by that? Is you talking about extra performance?
I think it's a bit of performance, but also where you're actually getting the returns. So since a lot of these families are still actively involving in their own business, you will imagine that a lot of those businesses are kind of getting to a very later stage of development. It's not like there's this family suddenly going into biotech and whatnot, right? They are still the very good old, property families, or even, consumption goods and whatnot. So talking to, let's say, new type of ideas, new managers coming in with new ideas, sometimes even, excite them a little bit to think, oh, wow, maybe this is something that I would like to go into. So in a certain way, I will stop there after this, is that when we go and look at the manager, it's not so much as in, oh, look, I need to find a manager that make money for me. Actually, a lot of these people are looking for more like a business partner. And I think that's a very, very important point for a lot of the managers that would like to talk to a family office, right? You will find yourself spending much more time talking about your aspiration, why you want to start a business, being a fund manager. What drives you? What makes you different from the others? And a lot of the times they want to see the motivation behind, right? You don't need to be too technical. At the end of the day, you will lose them halfway if you are too technical into whatever you're trying to achieve. When they allocate money, that means they trust you, just like they trust their business partner. And so that's why they're in the game to find a business partner for a long term, and not just, oh, who can make the best return in the next quarter or even the next year.
I wanted to make one comment on what my colleague said about not being too technical for the family offices. You should take the opposite effect for a public pension plan. Assume that we have talked to your strategies multiple times, and what we want is evidence that you have an edge, and normally that comes from being very technical about what you bring to the table. So that's just a different philosophy.
So everyone's trying to find the superpower of the manager. Are we have any luck with Philippe? Philippe?
Yes, I'm here. Yes.
Your motivation, please, for New Alpha investing in managers on behalf of your clients. What provoked you to do it, and has it changed over the last few years?
Yeah, actually, just to actually, there's a series of drivers, okay, for allocators to engage in emerging managers program. Actually, we are at New Alpha. We are relatively well located to see these various the spectrum of these factors, okay? And actually, I would say that they vary from pure financial purpose. And let me just describe the two ends of the spectrum, okay? If okay, as actually it was said before in this panel, and even for the previous panels of this conference, okay, in the pure financial drivers are typically accessing for an allocator, accessing the alpha generation potential of these emerging managers, because these emerging managers are newer, smaller, more motivated, nimbler, and so on and so on. Okay, everybody knows about that. The other also pure financial drivers for allocators to invest with emerging managers are also about the access to capacity, which is a bit less financial, okay? But the capacity, diversification, and innovation, okay? There's actually a mix of pure financial drivers and less financial. And at the other end of the spectrum, in the purely non-financial, I would say, they're actually, and the examples are actually, there's a few examples in France and in Canada, in Quebec, actually. You may have, a group of allocators led by regulators or government institutions willing to support their local industry, their local investment management industry. And in this group of drivers, obviously, the allocators are actually are developing another set of drivers. Okay, they want to push and support smaller managers, local managers, for various reasons. It may be to stimulate the industry. It might be to create a hub of financial know-how and an ecosystem locally. It might be that we see that in France with private assets like fintech, or we can see that also in public assets. The same situation also was seen, is still seen, and for a few years now, and with relatively great success in Quebec, in Montreal, with the emerging manager program there. So I would say, depending on the situation, you may have pure financial drivers, and typically those we can see and was said before, and to non-financial. I would like another set of drivers that are just pure conviction, like the set of factors we can see in with some public pension plan in the United States, willing to actually inject in their portfolio of managers. They dedicate capital. They're willing to inject a more effective image of their own community of pensionists. We can see that in California. We can see that in Illinois, where actually the pension plans there, they promote diversity and inclusion, and they want to actually push in front of their community. Well, you represent, let's say, 50%. I mean, women, for example, represent more than 50% of our base of pensionists. So we want actually some women to manage your money. So it won't be 50%, but it might be 5, 10, 15%. So this is another set of factors explaining the allocation of capital to emerging manager program.
Thank you. So moving on from a little bit of the how to, from the why to the how, my first question to you, Kirk, is what are the expectations that you have internally when you are about to make a decision to invest in an emerging manager? What do you expect, how do you expect them to be organized? What are the minimum requirements that you anticipate that they might need in terms of having a person in a particular position, whether it's the chief operating officer or risk manager? What are the bare bone minimum requirements that you expect from somebody that you're starting to invest in?
So I think that the benefit of having a dedicated emerging manager program is that my expectations for my managers are very different than what they would be for a larger firm. So I understand that my manager could just be 3 people. That's okay for me. My first objective is to identify the investment talent. But as I'm working to identify the investment talent, I'm also trying to understand the manager's vision, where they expect to be, and they need to be able to articulate that to me. So I always ask that question, what do you expect to be doing? Where do you expect to be in 5 years? That may seem to be a simple question, but that's a very important question because it lets me know if they're an investor or a business owner. What's important for us is to find business owners who are good investors. That is the only way you will have the firm growth. So what we spend a lot of time doing is acknowledging that you will be not as robust of an infrastructure, but that you have a good idea of, I will add a chief operating officer when I get 300 million. I will add a general counsel in-house when I get to 500 million. Up to that point, my expectations are that you will outsource those type of responsibilities because you do not have the capital. You don't have the fee income to support that. And I'm comfortable with that. So that's a normal part of our evaluation.
And Daniel?
Yeah, I mean, I agree mostly with what Kurt has to said. I think the only thing I may add one more, at least from a family office perspective, is again going back to the point of what's really is the aspiration of that person. I mean, like we all know it is very, very difficult, especially in Asia, to start up a fund, right? Nowadays, with all these platforms so hungry for talents, we were just joking, they may not even, show up on my radar screen, they already got poached or snapped by most of these platforms. So for those that have that, aspiration to come out and say, hey, look, I want to launch my own fund, what really is driving them, right? And do they have what it takes? Like, what Kurt was saying, I completely agree. You may be a very good investor, but you could be a very lousy business manager. And if you don't have, that talent in-house to run that business, who's going to be there to run that business for you, right? So a lot of the times, especially in the early stage when we're talking to these aspiring managers, it's usually over a drink or something, and we just say, hey, look, son, do you really want to get into this, right? What is it really for you, right? And hopefully we want to hear something more than just, fame or the pride or so-and-so came up and raised so much money and I'm so much better than him, I should be able to do the same, right? These are something that probably should avoid saying in front of a potential allocator to you.
Philippe, how about
Yes.
from your perspective, what are the minimum requirements that you would expect from a manager that you want to move forward with and invest? I mean, do you think that they should have a chief operating officer from day one, or a risk manager, depending obviously on the strategy? What are the minimum expectations that you anticipate?
Obviously it's a very I would say complex question with a multitude of potential answers and solutions. But actually, if we summarize and based on what we are of our experience of about almost now 20 years of experience in allocating with emerging manager, I would say there are two minimum requirements. One is pure. I'm not saying it's a requirement, but actually, I would say the most credible successes we have seen were generally based on a tandem. I mean, not one, leading business owner or leading portfolio managers, and actually, one leader. Actually, the greatest success we have seen and the most stable path to success were generally achieved by a tandem of two. Generally one good portfolio manager and one good business developer. And when both of these two characters are actually it's very rare that these two characters are in the same body, in the same human body. They're extremely rare. But when they are with two different people, and if their relationship is stable, and generally it works well. Okay, this is the first one. The second requirement I would emphasize here is more about I would say the financial health and the business development achievement. Generally, emerging manager, when we assess their financial condition, their break even and all that, generally they are very optimistic. And because it's part of their situation, they are just starting their business, and they have a lot of enthusiasm. What is very important at this stage is to look at I would say the crash test scenarios, okay, the bad conditions and so on, bad market conditions, and it's very important to make sure that the emerging manager has the strength to potentially resist through a bad, negative or adverse market cycle. For example, it's in public equities. Imagine we have two very negative years where markets are down 20%, 25%. So how the manager will do with obviously less assets, so less commission, less fees, less income, and this is very important to assess that and to make sure that the manager throughout actually not only the first 2, 3, 4, 5 years, but even beyond that, has enough I would say not only energy but enough strength to go through the cycle. That's very important to assess that continuously and to provide potentially guidance and assistance throughout this cycle.
That's interesting. Okay, let's move forward more into the third area, which is what. I had a few conversations with a number of different allocators recently in the US and in Europe, and I'll just go through very quickly a list, and then I will hand over to each of you. What kind of themes are you looking for, or would you be, putting up highest on your list of managers today? So, for example, on my list, which I put together, it's obviously AI and digital transformation, medical devices, health tech, genomics, automation, robotics, green tech, and wearable technology, which obviously is attached to VR, and then sports franchises and real estate. What are the investment themes that you would perk up your ears? Maybe Daniel, you can start off with.
Yeah, so maybe I'll start off by saying usually we look at manager more from a bottom up rather than a top down. So it's not common for us to come up with an investment theme like, oh, these are the strategies that I'm looking for. That being said, I think recently, especially talking about local families allocating, going back to my point about the aspiration, we would like to hear something that what they are doing is really contributing to the society and at least to the local economy, so to speak. Could be a strategy that helps to drive out some of the inefficiency in the markets. It could be a strategy with some impact on engagement theme behind it to help drive, let's say, the development of the local and the society at large. A lot of the times, what we want to really hear is that it is more than just, oh, it's a strategy that I'm going to make a lot of money. This is, basically the theme that we are looking at much more these days.
How about you, Philippe? Have there been many, as your role as more of the intermediary, what are the kind of themes that you think are interesting for your clients, looking the years ahead?
I think at the moment, the search for innovative themes is less prominent than it was, let's say, a couple of 3-4 years ago. At the moment, the search for emerging managers from our clients who are allocators are basically to build, to actually identify and allocate capital to relatively, I would say, traditional themes. Obviously, public equities, active management, particularly in some pockets of under-researched asset classes like emerging markets. In some also, with some also sector-focused managers, where actually the research to gain knowledge is relatively difficult to achieve. For example, in biotech, in everything about health and sophisticated research there. So this is what actually allocators are looking for. There's no very, very innovative things at the moment. The search is for actually managers who generate alpha and good and strong return, and who have also some capacity for the future, management capacity for the future.
Kirk?
Yes, I think for us, we have broad categories. So within private equity, I am buyout heavy. So I'm focused on buyout strategies. I do not do venture capital. I invest in growth equity. In real estate, I am investing in value add and opportunistic strategies. Infrastructure, the same, value add, opportunistic. The key for us is, I'm sorry, you had a question?
No, I was just going to say, does real estate include data centers?
So, the funny thing about that, data centers has actually sparked a lot of discussion whether it falls in infrastructure or real estate. So that's up to the plan. Honestly, if you're making me money, I really don't care where you go as far as what silo. But yes, that has been a lot of conversation there. And then for the public markets, if I'm investing in hedge funds, What's important is the ability to scale. For any of these strategies, what's important to me is that, remember, my limit is $1 billion. The reason it's $1 billion is because that size allows TRS to write a normal check for them, which is somewhere between $100 to $300 million. So even if a strategy is the strategy right now, even if everybody is only talking about AI, even if everybody's only talking about private credit, that's not important to me. What's important to me is the alpha profile. Can you generate the returns that I need? And can you scale? Can you grow your AUM to the level that's important for me to allow you to graduate from my program?
Great. Well, as we roll towards the end, let's, I'd like to find out from each of you, I'd like to hear a success story. If you when and how you found a manager, and what your experience has been from the start to the end. And I think this will be very interesting for a lot of the asset allocators here in Japan who are wondering, you know, would we be throwing money away at small guys and they'll just remain small forever? Kurt.
So I'll give you two examples, actually. So the first example is a very recent investment that I did for a hedge fund investment. The fund is a woman-owned European credit-focused hedge fund. We came into that fund when they were just under $100 million. So we came in after the seed capital. One of the benefits of being TRS and being as well known as we are is our capital is what I call acceleration capital. And what that means is if we come in and then I serve as a reference for that manager, you tend to see the AUM grow. So we made our investment in April and they were just under 100. We pushed them over 100. The manager informed me as of January of this year that she was closing her founder's share class. So she was able to get the benefit, the acceleration of our capital. In that time between April and January, I did at least 8 reference calls for her, because that's part of our relationship. If we have capital, we want your firm to grow. So that's a success story for us. We came in early, and the manager benefited from that capital, and the manager has grown.
Can you say approximately how much money she manages today?
Right around 225.
That's pretty good.
Yeah. And so for her, this has accelerated her to the stage that other people can look at her because they have their own floors. So, but in the interest of time, the other example is actually in Paris. One of my managers is a female-run biopharma manager, and they struggled to raise their first fund. It took them a long time. But she's generated 2 exits in less than 4 years. Both of them happened last year, and they generated the returns to her investors of over $500 million. That's a success story. Our focus is to find the managers early and benefit from that success. People who come in afterwards, great, they've been proven, but our job is to be early, take the risk of identifying, and then benefit from that.
That's great. Daniel?
I have 2 as well, but it will be quick, more in an Asian context. First one is a team that obviously overexpanded themselves at the very beginning. They have, offices in 2 cities, one in the US, one in China. And when they come to us, they are down to their last $1 million working capital. We were introduced by basically some of his uncles and whatnot. And I think what the chap did right was he coming in with the humility and the fragility. So he was basically saying, look, obviously, I'm not very good at that. I actually made some mistakes. What do you think will be a good thing for me to do to come out from here? But obviously, he is actually very talented. He is one of the earliest to successfully shorting Chinese stocks, right? So it's a genuine long-short equity manager doing China. And then somehow he impressed a few of the families that are in that meeting. And then one leads to another that somehow we managed to put together a group that backed him and ride it back up. So I think they peaked at around 5 billion eventually. Yeah, and then they have been returning capital, and then, so very successful. The other one, also an Asian team, and this one also we have every respect, got introduced by some fellow family office, come in. They run a quant strategy, and then they come in, crazy numbers, like huge double-digit numbers, but on the other hand, volatility is very big. And then some of us are asking him, look, well, since the numbers are so good, can you dial down a little bit? I think they were targeting 35 to 40% vol back then. So we're asking them, look, will you consider dying down? And then the answer is no. Is that, this is what we are, right? If you can't stomach this volatility, probably you shouldn't be investing in us. And again, that impressed some of the, obviously we're taking the advantage that we are family offices, we can stomach these kind of volatility. And then the rest is history. I think this team now, they run around 5 to 6 billion as well. And they annualize close to 30, 26, 27, yeah. Not for everybody, but then again, I still remember also very young, 2 young chaps, and just sticking with this guy and said, this is who we are. I understood that they actually turned away 2 tickets of around 300 to 500 millions from very big institution. I mean, obviously, these institutions need them to dial it down.
That's very interesting. Philippe, how about you? Very quickly, a success story you can share with us.
So many. No, actually, I'm checking. No, actually, there's several. Actually, this question is interesting because it you can consider how you measure the success. It can be the number of jobs, for example, for with the driver about pushing local managers. Okay, it can be also the accumulation of assets. So, but actually, there are several ways. No, actually, the couple of success I would have in mind, actually, those were, and actually there's a word that Kirk has mentioned, is the word graduation. To graduate an emerging manager, typically from an emerging manager program to the main portfolio and pension plans. They generally have this approach, and actually I have in mind two managers actually who were graduated. And actually, the meaning of the word is important. It reminds us back to university and so on. So graduating managers is important. And typically, I have 2 in mind. One actually is a New York-based credit relatively short duration credit focused manager who graduated from and actually receiving initially a $50 million ticket from the allocator, and actually now he's running about $350 million for the same allocator, and this is typically a success. Another one actually I have in mind is a French manager. We came in, he had it's a public equity, long-only public equity manager focusing on small mid-caps. We met him, they had about 250 million euros, so approximately the same amount in dollars now. And we allocated 50 million for Emergence, so the French emerging manager program. And about 6 months later, they had a mandate from the oil fund, so the NBIM, so the Norwegian oil funds, and which is a sovereign wealth fund for Norway. and now they manage about 2.5 billion euros. So strong growth, and actually, interestingly, that kind of growth can be not only measured in terms of asset, but also and we do that for the French emerging manager program. If we structure a revenue sharing scheme that actually comes on top of the return for the allocators, that success can be not only a success where you can actually say, okay, I'm very happy, I congratulate you, but also you can profit and benefit financially from the success. And the measures I'm mentioning actually, so over the duration of the investment of the allocation, which was about 4 years, actually he made a very interesting return and doubled its return through the revenue sharing agreement for the allocator. So we had a very great success with that manager.
We very much appreciate that. Philippe, thank you very much for joining us today. We really enjoyed that. Daniel, thank you for coming all the way from Hong Kong with your experience. And Kirk, as ever, thank you. And let's continue doing what we do, making it very successful for emerging managers. 皆さん、どうもよろしくお願いします。
皆様ありがとう。Thank you very much. Let's appreciate the panelists with a round of applause.